what's going on in the market and where is the market going, not only multifamily, but rentals in general. And what I'm going to focus on today is a guy by the name of Ken McElroy is accurate with what he's saying about where things are and where things are headed in terms of multifamily. If you don't know Ken, he's a guy that owns thousands and thousands of apartment communities, thousands and thousands of units, is in the multifamily space, what I call nose to nose, toes to toes. You know what goes on here at the Heartland Multifamily Show in terms of where I think they're going, where I think things are headed. So now let's expand this. Let's see what the big dogs are saying, if what they're saying is accurate. Welcome to the Heartland Multifamily Show, the shorter, more profitable path to multifamily ownership and investing.
I just sat down with some of the biggest real estate investors in the entire country. In this video, I'm going to break down exactly what they're doing, what they're avoiding, and the risks that they see coming. But more importantly, how you can leverage this insider knowledge to help you with your real estate investing. So the first thing is their outlook. What do they see coming in the next 12 to 24 months? So first, let me start off. While it was really easy for a lot of syndicators and people just buying deals and the market just went up, it was the same way for Wall Street. Everyone on Wall Street made a lot more money than they did on Main Street. But just like those syndicators and just like those people that raised a bunch of money, they also had a very rough 2 years as a result of the administration change, the higher interest rates, and all of the things that disrupted the market. So right now, there's a lot of people that were doing capital raising and investing and allocations into all these different markets at the Wall Street level that have completely been disrailed over the last couple of years and are now licking their wounds from having a really robust period of time to almost no business at all.
Yeah, I'll comment about that, especially when it comes to Wall Street. So I've talked a little bit before about some of the big companies, like you look at Blackstone, for example. And I'm not like picking on Blackstone, but if you check out their financial statements, recent financial statements, especially into 2024 and 2025, it shows you just how, just the impact that what Ken was talking about, higher interest rates, higher costs, inflation, have really affected a lot of not only the mom and pop kind of owner operators in multifamily, but also what I call the big dog. So he's right on about that.
So we had a few hard years, and now capital's starting to move again, as we know. And there's a bunch of reasons why it did. Some of the more notable ones were the higher interest rates, the higher inflation rates, and of course, the administration change. Till that point, before the new president, people really pulled back, and now there's still even a little hedge to see what the new administration is going to do. So the first thing is that they all believe and agree that inflation is here to stay. Nothing's going down from a price standpoint.
Yeah, 100%. Nothing's going down from a price standpoint. And this is arguably even more than interest rates. One of the main reasons why there's been kind of a stall in the market. And I think he's exactly right about that. Once those prices get to a certain point, they're not coming down. And that's with most everything, especially when it comes to multifamily or operations. I mean, this is not only in terms of things like wages, in terms of things like insurance, health, life insurance, those kinds of things, property casualty insurance especially. Also in terms of the cost of goods, everything from cleaners, air conditioners, furnaces, all of the things that you need to continue to operate a multifamily property. You've just seen massive jumps over the last few years in pricing. Yeah, I agree with that. I don't think that's coming down either.
Maybe asset prices might go down, and they already have. So we've already seen asset prices go down for lots of reasons, which we'll go into in a minute. But everyone believes that inflation is here to stay, and it's going to be a lot harder for the consumer. The second thing is we're going to see a lot more issues around affordability. So affordability is by far going to be the problem for the next 12 to 24 months for the person that's either buying or renting a home or just trying to survive on the paycheck that they already are getting, for example. They're only getting 2 to 4% annual wage growth, which is definitely not keeping up with the high cost of goods and services.
Yeah, so let's talk about that. Here's where it gets interesting. A lot of multifamily owners and operators, us included, we've had to raise rent, and we've had to raise rent actually more than what we would like to. And the main reason is we've got to keep up with these costs. We can't keep absorbing these costs. And it's almost like we get punched in the face one day, we get punched in the gut, the next day we get kicked in the back, the next day. It's like you can't stop this. And at the end of the day, from an affordability standpoint, it will impact consumers. Why? Because as those costs hit us as multifamily owner operators and investors, as those costs hit us, we're not going to absorb those costs. We're going to, like any other business, we're going to pass those costs on. And what that means is higher home prices for those looking to buy homes and higher rent for those looking to rent either single family or multifamily properties.
Therefore, the cost of borrowing or acquisition costs or refinance costs are all pretty much at a standstill right now. And banks are hedging. They're offering just between 50 and 60% loan to values. Hardly anything above that at all for existing property and even new construction, if they're even doing that at all. Because of high interest rates and because of high inflation, the people who are actually getting the money, the contractors and developers, the people in the local markets, pulled back. They pulled back because they were unable to deliver product at a reasonable price because everything's going up, especially the cost of borrowing.
Yeah, so let's talk about the cost of borrowing for a second. One of the things that I learned a long time ago, from painful experience, is you cannot over leverage. I mean, you can. It makes the returns look good, and you don't have to come to closing with as much money and all that. There's really great reasons that you're told to try to get into a property with as little money as you can and leverage as much as you can. I'm here to tell you that that's bad. That's a bad idea, and I learned that painfully a long time ago. So when we purchase properties, when we get financing, or when we're refinancing, the most that we will finance is 50 to 60%. And that's kind of been our case now going on 20 years. And it's interesting that Ken's talking about now lenders today, what are they doing? 50 to 60% loan to value. That's about it. Why is that? Because of what he's talking about with the costs of goods and what it's going to cost to operate a multifamily property. Lenders are really, really reluctant to go more than 50 to 60% loan to value, especially if they tie it to what's called a debt service coverage, or DCR, debt service coverage, which basically means in some cases it might be even into the mid 50s, even lower than 50% loan to value in some cases. So yeah, I've seen the same thing, but I mean, the good news is this is the way that we've always been operating. I shouldn't say always, but we've been operating now going on about 20 years.
So what has that done? That's created a supply problem. When it costs more for a contractor or a developer to deliver product to a market, then they pull back because the consumer either can or can't pay for that. And right now, we still have an affordability problem. So what we have today is we have a lot of supply that started 2 or 3 years ago that's hitting the market today, and it's creating what I would call short-term disruption, short-term benefit to the renter, concessions, flat rent, those kinds of things. What they all know and what you now know is that at some point, all those units that are being delivered right now will be absorbed. And then after that, there's not a lot under construction that will open in the future in the next 2 or 3 years. And that, again, is going to create a massive affordability problem. The tenants will have a short-term relief period. After that, you're going to start to see even more affordable problem. Rents are going to continue to go up because we're moving into a renter nation and we don't have the supply of property to be able to accommodate all the people moving that would normally be buying single-family houses.
Yeah, so I've got a book. I came out with a book about 7 years ago by the name of Renter Nation. And what he's talking about is exactly the case. And in that book, and by the way, you can get it on my website at no cost, by the way, I go into the weeds on why we are and will continue to become a renter nation. And he's right about that. And he's also right about the supply and demand. So we're seeing in our market, even here in the heartland of America, we're seeing concessions. We're seeing rents being flat. We're seeing more vacancy and less occupancy than what we've seen. And the main reason is, as he mentioned, the last 2 or 3 years, there's been a lot of supply that's been added to the supply pool. Okay. And so it takes a while for the supply of those apartments to be absorbed, those multifamily units to be absorbed. And while that absorption is going on, Helen and Frank that live in this apartment community, they're going to move to another community, and this is going on exponentially. It creates more vacancy for longer periods of time for multifamily owners and operators. So in answer to this, what happens is what he mentioned, really good short-term renter benefits, which means lower rents, maybe rents coming down a little bit, concessions, those kinds of things. But he's absolutely correct too when he talks about that's not going to last forever. That's not going to be the case forever. So when that absorption period finally ends, in other words, when those units are absorbed, what you're going to see is rents continuing to grow and rise. Again, not so much because there's greedy landlords but because of what? Inflationary and costs of operating the properties, and also making sure that the business operates at profitability. Okay?
Because single-family houses are not going down in price except for some areas, and interest rates don't look like they're coming down anytime soon. Right now, we're seeing some of the best real estate deals that we've seen in years. And while most investors are sitting on the sidelines, opportunities are opening up every single day. If you want to see the deals we're working on, how we structure our deals, and why we think today is the best time to invest, just click on the link below. The gap between the mortgage and the rent is at an all-time high, which means that more and more people are going to be forced into the rental housing side, and we don't have the supply to accommodate it. So it's only going to lead to one thing: the high cost of rent, which is going to translate into higher values into the multifamily and the build-to-rent space. So Wall Street sees this just like you should be seeing this. All you got to do is look out 18 to 24 months and you'll see it. The reason I had over 20 meetings with all these different groups, now the Wall Street money is now looking for local operators to put that money to work for them. Here's how the people on Wall Street get their money. They get it from you. You put it into an insurance policy, you put it into a pension, you put it into a retirement account, and then it makes its way all the way up to Wall Street, and then Wall Street reinvests that back into guys like me. And there should be no reason that you shouldn't be trying to tap into that same money, because it's really your money in the first place. So in those meetings that I had, the big money or the Wall Street money, in all the meetings that I had, they all had the same thing. They were looking for the right operator in the right market. Just no different than you would if you bought a piece of real estate somewhere else and were looking for a property manager. They're looking for somebody to invest alongside of them as a partner to be able to manage and pick assets for them. That's what they're doing. No different than you bought something out of state and were looking for a property manager. It's the same process. So number one, they're looking for a good operating partner with a good track record. So the first part of every one of these meetings, all around our track record, the markets we like, and what we see. The second part of all those meetings is, what are the terms, what markets do they like, and what does the underwriting process look like? In other words, if I find the deal and I give it to them, do they make a decision in a day, a week, or a month? That's really important from my standpoint, because in these market conditions today, you have to have somebody that can move really quickly.
Yeah, he's exactly right about that. And what he's talking about there is he's talking about having some congruency as a partner. And so, yeah, of course, you want to be on the same page in terms of what the terms is. Does everybody agree on what kind of property we should be buying, what kind of return it should be, when the distributions are going to be, the communication. So all that is important. But there's two main things that you want to make sure that you have a discussion about that he didn't talk about, which are equally important. Number one is exit. How will the exiting process be handled? What can you expect when you exit? There's not enough conversations about that. As you know, it's a lot easier to get into an investment than to get out of an investment, especially with real estate, because with real estate, you typically have to sell sometimes the real estate. Okay, it's not a liquid kind of investment. Okay, so yeah, all of the terms and property type and location and, do we get along and do we trust each other? All of that's important, obviously. But you want to be having conversations about the exit part of it, just so you are sure as to how that process goes. That's number one. And number two might come as a surprise to you. You want to make sure that you are politically aligned. Now, I'm not saying that you have to, be a part of the same political party. I'm not saying that you've got to both either love the left or love the right, but you need to philosophically be on the same page here. Okay, because what far too many investors find themselves getting into is maybe they lean very much to the right politically, and then they get involved with somebody that maybe leans more to the left from a business standpoint, and philosophically, all of a sudden you start having a problem, don't you? Okay, and the same can be said the other way. If you have a property sponsor that really leans to the left politically in terms of the kind of properties that they think they want to be purchasing, the kind of hires they think they want to be making, the kind of philosophy on how they move forward with residents in terms of maybe lease enforcement, those kinds of things. If they're leaning very much to the left and you're a very much right-leaning kind of investor, you're going to have problems there too. Okay. And so you want to be getting an idea of how philosophically those people you're going to be investing possibly for years feel about things politically in terms of the operational philosophies of the apartment community or the apartment fund that you're getting involved in. Look, guys, there's no right or wrong answer either way, but it is a question that needs to be asked, especially if you're going to be doing business with somebody and possibly investing either tens, hundreds, or even millions of dollars and be involved with them in business for many, many years. The wrong time to find out if you're not, congruent politically in terms of philosophy and how things are done and how business is conducted, guys, is after you make the investment. Okay, it's after you make the investment. So make sure you're not only aligned in terms of having an idea, number one, of exit strategy, but you want to make sure that, as crazy as it sounds, it doesn't sound crazy today, but it's necessary today. You want to make sure you're at least aligned politically and philosophically with those investments too.
The second big theme that kept coming up over and over and over were operating costs. Now, you guys all know and you see insurance rates, for example, are up really, really high, or property taxes, or utilities, or even just some basic capital costs for appliances and flooring and things like that. So that was kind of the theme of the day as well. This is precisely why I like having a property management company, because as you guys all know, when I wasn't really buying in the last few years, we focused on our operational costs, our systems, and our processes, and tried to buy down as many of those kinds of things and manage all those things so that I knew all the costs running through our company were being watched each and every week. As an example, one of the exercises that came out of that from my company was we hired a full-time director of procurement. And all that person does, they review every single contract in all our different companies each and every year. In other words, nothing gets automatically renewed. Everything goes out to bid and everything gets vetted. That is one way that we're trying to control operating costs, which we believe are going to continue to grow up and be more and more of a problem.
That's a really, really good point. And one of the things that I learned a long, long time ago, again, expensive experience, and he does a great job of highlighting it, is being on top of your operational costs. And sounds kind of common sense, right? Well, what you find is when you don't manage your own properties, when you have somebody else managing the properties, you find out that they don't have the best things in mind in terms of the most efficient and effective operational costs. And look, it's not saying that a management company that you may have hired, or maybe someone to manage a property for you. It's not to say that they don't have your best interests in mind. More than likely, they probably do. But are they doing the same kind of due diligence in terms of what the controlling and making sure that those operating costs are as low as they possibly can be? More than likely, they're not. And what you learn is the best way to do it, if you can, at least to get to this point, is manage the property yourself. That's why with all of our apartment communities, it sounds like, just like Ken, we do all of our own management. Okay. And one of the main reasons that we do this is to contain and control our operating costs. It's not only like an obvious thing that's important, but as inflation and interest rates and those operational costs continue to get bigger and grow and get higher and higher, man, you got to be on top of this. There's really no way around it. And if you're not on top of it like this, being in the multifamily investment business as an owner investor is not going to be that much fun or profitable.
One of the greatest questions by some of the smarter groups was, what did you underwrite for rent growth? What did you underwrite for concessions? And what did you underwrite for operating costs? And what did you underwrite for your interest rates, current and in the future? Those are very, very good questions, because those are things that we debate all day long internally. When you're talking to some of this big money from Wall Street, those are the things they want to know. What are the assumptions that you're following, and how are you managing all those little details inside of each property? How are you managing each one of those details inside of each asset? So the first thing is, you guys should be at least considering what the big money is doing right now, where it's headed and why, what markets and how they're underwriting these deals. So number one, that's investing in landlord-friendly markets and staying away from these high regulatory markets. This came up a lot, where they're saying the last thing they want to do is go into a market where potentially there could be rent control later to cap the rent growth if they've underwritten in a certain way, for example.
Yeah, 100%. And I've said this over and over again, podcasts. And I mean, there are states I will not go. I will not go to Minnesota. I will not go to Illinois. I will not go to California. And I will not go to New York. And there might be more I might add to that list. And the main reason I won't, and by the way, Illinois is right next door. Minnesota is like right next door. So it's like a couple hour drive to both places in terms of operations. And so we could easily own apartment communities in those markets easily, but there's no way I'm going to get involved in an over-regulated market like those when it comes to multifamily. And look, Wall Street knows that this is the case. That's what he's saying, and that's why they're headed towards markets like, let's just say Iowa, where it is a landlord-friendly state and is not over-regulated and have a whole bunch of issues and problems from a rent control or regulatory standpoint. Yeah, it doesn't surprise me that that's the case.
Where are property taxes headed in a certain market, and where are insurance rates headed in a certain market? Those are things that you should know, and those are things that they asked.
Where are insurance rates heading in those markets? You don't know where insurance rates are heading in any market. You really have no way of knowing. All you can do is try to do some research, try to gain an idea of what the future might be. But I can tell you from real world experience, you never really know where those insurance rates are going to be. You just do your best job in projecting out best, middle, and worst case scenarios. That's the way it's going to be. Nobody has any kind of crystal ball on where insurance rates are really going to go in markets, unless it's a market that just recently had some huge, devastating losses, property casualty losses. You can pretty much bet that those markets are going to have some pretty steep increases. But aside from that, it's really hard to gauge where those are going. So you always want to err on either the middle case or the worst case scenarios and not get too caught up in best case scenarios where property casualty insurance rates are going.
The second thing is watching the interest rates. Obviously, nobody knows where interest rates are going to go, but there's lots of ways to hedge risk against interest rates. And one of them, of course, is fixed rate debt. If you're buying something that has really good fundamentals in the future and you have fixed rate debt, then you don't necessarily have to worry about where rates go. If rates go down, you refinance going down. If rates go up, hedge that mortgage payment. You don't have to worry about the cash flow potentially from rate going up. And of course, these firms are extremely bullish on housing. And that could be single family, it could be build to rent, it could be multifamily. And they're staying away from office at the moment, especially with now the new DOGE issues coming up around the federal buildings, some of the other leases that they're going to break. They think that office buildings are going to be even in worse shape in 2025 and 26.
Yeah, he's 100% right about the office building process. And I mentioned that in a podcast not too long ago, that market is pretty much, with maybe the exception of a few bright spots here and there, that market's in really, really big trouble, especially when the GSA, Government Services Administration, starts pulling tenants out of there. And one of the worst things that you can do, in my opinion, is you start buying these office buildings, which you can buy at a discount, and then you get the idea of converting them into apartment properties. Now, on the surface, that might sound like a really, really good idea. Let's buy this building for $50 a square foot, and let's go ahead and let's convert them into all these 3 or 4 bedroom apartments. Now, look, I can tell you from experience, again, that when you buy a building that was not built as, manufactured as, thought out as a multifamily property in the first place, and you convert that into living space that's now 24/7 living space, you are asking for huge potential issues and huge potential problems. And this is on top of millions and millions of dollars being spent on that conversion. That's not going to matter as much as you think, because the skeleton, the bones, the framework of that property and all of its behaviors, I'll call it, is already in place. And so those are things that you want to run away from as fast as you possibly can.
So every single one of these firms are looking for great operators. Because if you think about it, if you're giving me money, you're also looking for a great operator. It's no different. They just have more zeros and more commas. If you want to grow as an investor, you have to learn how to manage or manage a manager to maximize your returns on any investment that you make.
So there you go. I mean, again, that was Ken McElroy. He's got a pretty good following regarding what's going on out there, what the big dogs are up to, what the big dogs are doing in the real estate space. You found that there's probably most things that he mentioned, I thought was probably pretty accurate in terms of where I think things are going, in terms of me being, nose to nose and toes to toes with this market here every single day in terms of where I see things going. I think there's a few things I had a little bit of a disagreement with, and maybe a couple things I didn't quite agree with him on in terms of what I think, especially philosophically. But yeah, there were some things there I thought were pretty good, and in a way, with about 60 to 70% of what maybe some of the big dogs are thinking, I think I'm pretty much in line there in terms of what they might be doing. And maybe about 20 to 25% I might not quite be on board, or maybe even disagree with what's going on there. And so one of the things I'd like to do here in the Heartland Multifamily Show from time to time is to react to some of the things that are out there, because there is a lot of information. And look, it's easy to put information out there in today's world. And by the way, that's not to say that all of my information is always 100% accurate. Look, guys, I'll definitely make a mistake from time to time, and I won't be right 100% of the time. But what I do like to do is compare and contrast what's going on out there, especially if there are those that have a lot of maybe possible influence or maybe a following, and to comment and react to that and give you guys what I would call a heartland perspective of what you should be thinking of and what you should be considering as you might see those, listen to those, and even react to those. All right. So thanks for joining me on this reaction episode to what the big dogs are doing out there investment wise on this episode of the Heartland Multifamily Show, the place for all things multifamily. Have a great day. We'll talk to you later. See you. Bye-bye. If you want to get your hands on more great multifamily real estate content, make sure you click here. If you want to invest passively in great multifamily real estate, make sure you click here.